Every other video on YouTube is going to talk to you about how to find a reasonable compensation if you're filing as an S corporation. But in this video, I want to walk you through how to find the perfect W-2 salary for you in order to minimize payroll taxes and maximize your QBI deduction, which was recently made permanent by the One Big Beautiful Bill Act. We'll also go through some client scenarios so you can see how this looks in real life. So the problem for a lot of business owners who are filing as S corporations is figuring out how much should I pay myself in the form of a W-2 salary and how much should I pay myself in the form of profit distributions on my K-1. And it's really important that you get this right because getting it wrong can lead to a few things. Number one is if you get it really wrong, you can get in trouble with the IRS for not paying yourself a reasonable compensation. That can lead to additional taxes, penalties, interest. You definitely don't want to do that. Number two, if you are paying yourself too much, then you could pay unnecessary payroll taxes. Number three is if you're paying yourself too much or too little, you could potentially be limiting your QBI deduction, which we'll talk about here in a moment. And number four, if you're paying yourself too little, you may not be able to make the contributions to your retirement accounts that you would otherwise want to make. So we're going to go through a 5-step process to help you determine what is the perfect W-2 salary for you as an LLC owner that files as an S corporation. The first step in this process is going to be determining what is your minimum reasonable compensation. Now, reasonable compensation is a term coined by the IRS that doesn't necessarily have the best guidelines around what that means. Reasonable compensation is going to be what you pay a shareholder employee for the services they actually perform for the company. This is going to be based on job duties, the amount of time it takes, the amount of experience it takes, what the pay is like for similar roles in that area, in that field, and the profitability of the business. If you're unsure what your minimum reasonable compensation is, pause this video, go and watch some of the other videos on YouTube. There's plenty of them that will walk you through the steps to determine what your reasonable compensation is, or reach out to your tax professional and they can help you nail down a number as well to figure out what is the minimum reasonable compensation for my role in my S corporation. Now that you've identified the minimum reasonable compensation, the next step is to determine whether or not you are phased out for the QBI deduction or the qualified business income deduction. The qualified business income deduction was introduced in the 2017 Tax Cut and Jobs Act and rolled out in 2018. And what it did is it provided an additional deduction on your personal taxes for business income. So business income is going to be the portion of the income that you derive from the business, specifically in the form of your K-1. If you make too much money, you begin to lose the ability to claim this deduction. If you're a single filer for 2026, the phase-out begins at $201,775. If you are a married filer in 2026, then the phase-out begins at $403,500. The phase-out range is $150,000. So most of the time when people are trying to determine what their salary should be for their role in their S Corp, they're just looking at their business, their profitability, their wages, and their expenses. But in order to take into account the QBI deduction, you need to be looking at your personal tax return, which is also going to include an income from a spouse or income from rental properties or investment income. All of those are going to impact your taxable income, which is going to determine whether or not you're eligible for this QBI deduction. If you are not phased out for the QBI deduction, then you should just pay yourself the minimum reasonable compensation to avoid paying excess payroll taxes. If you are phased out, then we need to move on to step 3, which is going to be determining whether or not you are a specified service or trade business, an SSTB. The IRS defines a specified service or trade business as a business where the principal asset is dependent upon the reputation or skill of one of the owners or employees. So this is going to cover fields like doctors, accountants, financial advisors, professional athletes, performers, anything where your name, image, or likeness is something that is going to be an asset of the business. So what does that leave as non-SSTB businesses? This is going to be pretty much any business that falls under retail or manufacturing. Real estate agents are specifically non-SSTB businesses. Also architects, engineers, nursing home owners, gym owners, they're all going to fall under that non-SSTB umbrella. So if you are phased out but you are an SSTB, you should just pay yourself the minimum reasonable compensation and move on. You can finish watching this video now and save yourself some time. If, on the other hand, you are phased out and you are a non-SSTB, then we need to move forward in the process. It may make sense to pay yourself a number other than your minimum reasonable compensation. Step 4 is going to be determining whether or not your reasonable compensation is greater than or less than 2/7 of your qualified business income. We'll talk about in a second where this 2/7 number comes from. If your reasonable compensation exceeds 2/7 of your qualified business income, you can stop here. You should just pay yourself the minimum reasonable compensation and move on. If, on the other hand, 2/7 of your qualified business income is greater than your minimum reasonable compensation, then we may be looking at a situation where it makes sense to pay yourself more than the minimum reasonable compensation. So the 2/7 rule is going to come into play when you are phased out and you are a non-SSTB, and it comes from the limitation on the QBI deduction. So the QBI deduction is either going to be 20% of your QBI, your qualified business income, or 50% of the W-2 wages of the business, whichever is less. So the point at which you would maximize your QBI deduction would be when your 50% of your W-2 wages is exactly equal to 20% of the qualified business income. Now, qualified business income can be further defined as your earnings before compensation, before salaries are paid out. So if we were to rewrite that formula, so 1/2 of wages is equal to 20% of qualified business income, we could say 1/2 of wages is equal to 20% of earnings before compensation. At the end of the day, what that's going to give us is that the optimal W-2 is 2/7 of qualified business income. So we've gone through the steps so far and we've identified what our minimum reasonable compensation is. Next, we've identified whether or not we're phased out. If we are phased out, are we a non-SSTB? If yes, then we need to decide whether or not our minimum reasonable compensation exceeds or is less than 2/7 of our qualified business income. If 2/7 of our qualified business income is greater than our minimum reasonable compensation, then we need to move on to the next step. The next step is going to be to determine whether or not paying ourselves additional wages would save us on taxes. This is going to depend on a couple things. First, it's going to depend on your personal marginal tax rate, and second, your proximity to the Social Security taxable wage base. If your income is less than the Social Security taxable wage base, which in 2026 is $184,500, there's going to be one process that we'll go through. If your income is already above the Social Security taxable wage base, then it's a much simpler thing that we'll do. So if you're below the Social Security taxable wage base and you increase your wages by $1, it's going to create an additional 15.3 cents in payroll taxes between Social Security and Medicare taxes. And so in this situation, we have to determine, is that additional tax liability going to be offset by having an additional QBI deduction? The value of the QBI deduction is really going to be determined by your personal marginal tax rate. So if you increase wages by $1 and you get an additional deduction of 50 cents, then the value of that deduction is going to depend on how much tax it's going to save you. In order for that additional QBI deduction to outweigh the additional cost of the payroll taxes, your marginal tax rate needs to be in excess of 30.6%. Here's the math why that makes sense, but take my word for it. If your personal marginal income tax rate is greater than 30.6%, taking into account both federal and state income taxes, then it's going to make sense for you to consider increasing your salary above that minimum reasonable compensation number. If your marginal tax rate is less than that 30.6%, then raising wages is actually just going to cost you more in payroll taxes than it's going to save you by getting the additional deduction. There is still a situation in which raising your wages may make sense, which we'll talk about here in a second. So if your marginal tax rate is greater than that 30.6%, we'll want to raise your wages from your minimum reasonable compensation to 2/7 of your QBI. If your income already exceeds the Social Security taxable wage base, then this is much simpler because adding $1 of wages, we don't pay any additional Social Security taxes on. It's just the Medicare taxes the 2.9% when taking into account the employee and the employer side. And for virtually all taxpayers, it's going to make sense if you're already in excess to go ahead and raise your wages from that minimum reasonable compensation number to that 2/7 of QBI as well. So one edge case that I do want to point out here in case you're in that situation is if your current income is below that Social Security taxable wage base, and increasing it to 2/7 of QBI would put your income above that Social Security taxable wage base, it may or may not make sense to go ahead and increase your compensation. There is a little bit more in-depth calculation that we would need to do in your scenario to decide whether or not it made sense. So going back through those 5 steps, the first step is going to be determining what is your minimum reasonable compensation. And that's going to be the number that we start with. You shouldn't pay yourself anything less than the minimum reasonable compensation, or you could be setting yourself up for trouble with the IRS. The second step is going to be determining whether or not we're phased out for that qualified business income deduction. Again, being phased out, we're going to take a look at your taxable income as a household. So if you're single, just your income, everything that shows up on your tax return. If you're married, we're going to be looking at your married joint tax return. So this is where it makes sense to bring in information regarding a spouse to determine whether or not you are phased out. If you are not phased out, paying yourself the minimum reasonable compensation is going to be the ideal. If you are phased out, we need to move on to step 3, and that's to determine whether you are or are not a SSTB. If you are an SSTB, then we can stop there and you just need to pay yourself the minimum reasonable compensation. If you're not an SSTB, you may still be eligible to claim the QBI deduction. It's just going to be limited by 50% of wages or 20% of QBI, whichever is less. So if you are phased out and you're not an SSTB, the next step is determine whether 2/7 of your qualified business income is greater than or less than your minimum reasonable compensation. If it is less than, then you can go ahead and stop, just pay yourself the reasonable compensation. If it is greater than, then we may be looking at a scenario where it makes more sense to pay yourself additional wages from a tax perspective. Determining whether or not it makes sense is going to depend on your marginal tax rate and again how close you are to the Social Security taxable wage base. If your marginal income tax rate is greater than 30.6%, taking into account both federal and state, then we should probably go ahead and increase your wages from reasonable compensation to whatever it needs to be to max that QBI deduction, that 2/7 of QBI number. If you are already above the Social Security taxable wage base, definitely want to increase. If you're below Social Security taxable wage base and your marginal tax rate is less than that 30.6%, it may or may not make sense, depending on whether or not we'd be moving you above that Social Security taxable wage base. You'll notice for most people, the answer is pay yourself the minimum reasonable compensation. One exception is going to be if you need to pay yourself more in order to be eligible to make the correct amount of retirement account contributions, then you should consider doing that in light of your overall financial plan. Next, I want to take a look at 2 client scenarios where increasing their compensation above the minimum reasonable compensation resulted in tax savings for clients. So in this first one, what we're going to look at is an analysis that we did for a client in retrospect. She had originally been paying herself $70,000 in W-2 compensation, and her K-1 was around $220,000. That was what we consider her minimum reasonable compensation, and we were trying to anticipate what her business profit was going to be, so we're actually doing this in hindsight. We were somewhat close. Our goal here was to determine what would be the ideal salary to maximize that QBI deduction and minimize those payroll taxes. And you can see that the perfect salary for her would be $82,120. That's where the limitation for wages and for 20% of QBI were equal. That would be the best case scenario. In her situation, we had used $90,000 as an estimate, and so that's our current salary. But in her situation, the net tax savings was positive because their marginal tax rate was 38%. So this is one situation where paying more than the minimum reasonable compensation resulted in net tax savings for the client. Let's take a look at one more. In this scenario, we're going to provide a little bit more detail. So this individual was running a highly profitable business, $950,000 in profit before wages were paid out, was paying himself $120,000 in W-2 salary. And so he had a K-1 that was showing over $800,000 in profit. So you'll see here what is highlighted in red is which of these were limiting the QBI deduction. Was it 20% of QBI or was it 50% of wages? And you can see at 120,000, wages was our limiting factor here. This client had a marginal tax rate of 41%. And if we increased his compensation to the Social Security taxable wage base, this was in 2025, we're still limited by the 50% of wages. And so we continued to move up that ladder. And the point at which those two figures were equal was at around $271,000 of compensation. And in that scenario, the net tax savings due to the QBI deduction was about $55,000. The baseline case was about $24,000. Now, increasing his compensation that much did create additional payroll taxes, so we do have to take that into account. You can see that the additional payroll taxes that we generated was around $11,500. But even taking those into account, the net tax savings for this client was $19,500 by increasing his wages. And so, again, this is one more scenario in which paying the minimum reasonable compensation, which he came to us with his CPA's recommendation of $120,000, wasn't the ideal recommendation for the client. Actually paying himself a larger amount made more sense and resulted in net tax savings. So hopefully that was helpful for you and you now have a better understanding on whether you should pay yourself the minimum reasonable compensation or if you should pay yourself more in order to maximize your QBI deduction and minimize your payroll taxes. If you're in this situation and you think maybe I should be paying myself more than I am, feel free to reach out to us. We're happy to help. Reach out to your CPA or your financial planner as well. My details are going to be in the description below. And make sure you subscribe for more content that may be helpful for you.